Is it inflation, or are you just hallucinating? Are you seeing the economic data in your daily life, and is it all rosy? I would guess a resounding no. All the while, central banks around the world are reducing their dollar reserves and buying gold in record amounts not seen in history. Are central banks sensing weakness in the dollar and counterparty risk by holding it in reserve? If the smart money that usually run the printing presses are stocking up on gold, it makes sense that the ordinary investor prepare as well. If you think you may be falling behind in your financial goals, see the video description to access the free Inflation Retirement Calculator to make sure that you are on track. Also, please share your experience in the comments. To discuss the present economic environment and how investments in scarce and time-tested assets like gold and silver can help you secure your financial future, we will hear from macro analyst and investor Lyn Alden, economist and investor Keith Weiner, economist, White House advisor, and author Jim Rickards.
Clearly, what they're doing is diversifying away from the dollar. Take China, for example. I mean, they're bleeding reserves. First of all, their reserve position has dropped. They fear, and I think rightly, that we're going to try to inflate our way out from under our debt. That's the American way. Like, we don't actually default. We just inflate the currency away. So we say to China, here's your $1 trillion. Good luck buying a loaf of bread. And there's not much they can do about it. They say, why don't they dump the treasuries? Well, they can. I mean, the treasury market is large, but it's not that large. It can't absorb that much selling. But what they can do is buy gold, which they're doing by the thousands of tons, by the way. These are enormous purchases that are going on. If the U.S. does inflate the dollar and does destroy the value of the paper, what's going to happen to the gold? It's going to skyrocket. So what you have is a hedge position where it's like a seesaw. They own both sides of the seesaw, and one goes up, the other goes down, but they maintain the value.
But we are seeing a lot of dysfunction in the treasury market. Part of the reason is when the dollar gets very strong, the foreign sector generally stops buying treasuries. The main reason why, say, foreign central banks hold treasuries is so they can sell them if they need to defend their currency at some point in the future. And so we kind of have an issue where the Fed's not buying treasuries, the foreign sector's not buying treasuries, U.S. banks, due to SLR regulations, are not really buying treasuries. The end game of a very, very indebted sovereign country is that they have to do often QE type of activities, even when inflation's above target, just to support the bond market.
When you are a reserve currency, other people are funding your style of living, so to speak. Just look at the Argentinians. They're not a reserve currency. If they want to borrow, no one's going to allow them to issue Argentinian peso bonds. They have to borrow in dollars. So when you're not a reserve currency, you have to borrow in whatever is the reserve currency. So imagine a world where, let's say, the euro or something else was the reserve currency, and we had to borrow in euros. Well, all of a sudden we'd be vulnerable to exchange rate risk. You'd probably have much higher inflation. By the way, this happened once before in the late 1970s. The dollar was under so much attack and so much stress that Jimmy Carter actually borrowed in Swiss francs. The dollar was so unwanted and so in danger of collapse in the late 1970s that the United States had to go to the marketplace, and we issued Swiss franc bonds. They were called Carter bonds. So, and remember, that was a period of high inflation from 1977 to 1981. Inflation in the United States in those 5 years was 50%, 5-0. The value of the dollar was cut in half in just 5 years. So that's what, when you're in danger of losing your reserve currency status, that's what happens. So it's very valuable to the U.S. Unfortunately, we may be in danger of losing that status again. Over 60% of the reserves are in dollars, which they are. But in 2000, that number was over 70%. So the U.S. role as a reserve currency has dropped from 70% of global reserves to 60% of global reserves. Imagine if that kept going and all of a sudden we're 50. 50 is kind of a tipping point. When you're below 50, you're no longer the dominant reserve currency, and you might see euros and other currencies coming up.
Just a quick interruption to say thank you for supporting our channel. Please like and subscribe if you enjoy this video content. It really does make a difference. Also, a quick mention and shout out to one of our sponsors, Augusta Precious Metals. With over a decade in the industry, Augusta Precious Metals is one of the leading gold investing companies for trust, customer empowerment, and prices. The company provides 401k rollover services to tax-advantaged gold IRAs, as well as a unique gold investing educational webinar and resources for their customers, helping beginning and experienced investors protect their retirement wealth with confidence. Whether you are starting a brand new gold IRA or rolling over an existing account, the company will make this process seamless and stress-free. To find out more about Augusta Precious Metals, see the link in the video description to visit Augusta Precious Metals' official site to receive a free gold investing guide. Also, check out our video review of Augusta Precious Metals by clicking the link in the top right. Now, back to the episode.
Gold is the one financial asset that has no counterparty risk. You can own Ferraris, you can own cases of old wine. They have no counterparty risk, but they're not financial assets. And the bid-ask spread can be a mile wide in good markets. Gold is the one financial asset that has no counterparty risk. So if you think there's going to be some sort of crisis or problem, central banks might do some new crazy thing that they haven't done before. And you think, okay, I want to decrease my exposure to that. Gold is the asset, that you turn to. So institutions are looking at things probably arguably in a more sophisticated way. It could be that the central banks are aware of rising stresses in the system and seek to hedge against whatever risks they perceive.
But investors need to look forward. I call it the curse of the 2-second attention span. People worried about what's happening today or tomorrow. Well, that's fine if you're a day trader, but if you're an investor, you're worried about your retirement, you're worried about wealth, your children's well-being, etc. You ought to be looking a little further down the road. If we lose our reserve currency status, the Treasury will still issue debt, but the American people are going to have to buy them. The foreign interest will be reduced. Foreigners will say, hey, U.S., you want to sell bonds? Price them in something else. Right. Well, the first piece of advice I would give is position now. One of the questions I'm asked most frequently is, hey Jim, when's it going to be? What's it going to be? Almost as if I'm supposed to call them at 3:30 in the afternoon the day before, and they're like, oh, I'll sell all my stocks at the close and buy gold the next day. It doesn't work that way. I can see it coming, and I can describe the dynamics, and I can understand the magnitude of the risk, but I'm not going to know what day it is, because it's going to be some unexpected event that maybe none of us see coming. I can just tell you it is coming. So first of all, position yourself now. What I recommend to investors, you want about 10% gold. Maybe a little more if you want to lean into it, if you have a higher risk appetite, but not much less than that.
Gold holds a proven, time-tested track record as an economic constant that spans millennia. Why is it important to have an economic constant? What is the main question every person planning their retirement or building a business needs to ask themselves? Are we growing wealth or losing wealth? And how do we measure this? Gold is that tool. With a 5,000-year record that has withstood every economic business cycle, stock market booms and busts, global conflicts, and outlasting every faith-based fiat currency, gold is no one's liability. It builds wealth while preserving it. Owning physical gold and precious metals requires responsible sourcing of grades, purity, condition, the best prices, transparency, and most of all, security and storage. Gold IRAs are a tax-deferred means of owning physical gold and ensuring all these investing principles are met. We have reviewed and vetted the best gold IRA companies that meet all these requirements. See the link in the video description to access the free gold investment guides. An often used criticism for holding gold is the opportunity cost of gaining yields elsewhere, such as bonds or high-quality equities. Monetary Metals is a gold investment company that unlocks the productivity of gold by offering a yield on gold paid in gold. Monetary Metals delivers interest on gold through the company's gold fixed income investments, which aim to provide a fixed return with low risk of loss. This provides investors exposure to gold's unique attributes, plus a real yield that grows your total of gold ounces held. To learn more about Monetary Metals and their innovative investment products, see the link in the video description. If you have $100K of retirement savings to protect and want to take advantage of the best gold prices, see the link in the video description to sign up for the free Gold and Silver Web Conference hosted by Augusta Precious Metals. Thank you for watching.